Today is June 28, 2025, and as global markets come to a close on this final trading day of the week, we take a deep dive into everything that shaped the financial landscape: equity movements, central bank signals, geopolitical developments, inflation trends, commodities performance, crypto market volatility, and the big tech earnings landscape. Investors around the world woke up to a cautiously optimistic environment, with lingering inflation fears, a mixed bag of macroeconomic data, and a growing course of central banks shifting from hawkish to more dovish rhetoric as signs of a global slowdown begin to materialize. But behind the headline indices, there's a lot to unpack. Starting with the US markets, all three major indexes ended the day in the green, although gains were modest and driven largely by a rebound in tech and renewed interest in high-beta sectors. The Dow Jones Industrial Average closed up just over 110 points, the S&P 500 rose by 0.4%, and the Nasdaq Composite outperformed with a 0.9% gain, powered by strong buying in mega-cap tech names. Nvidia surged 2.3%, Amazon climbed 1.8%, and Apple advanced 1.2% as investor appetite for AI and cloud infrastructure remains unshaken. While bond yields held relatively steady today, the underlying sentiment in fixed income was driven by signs that the Federal Reserve is likely to begin easing rates as early as the September meeting, provided, of course, inflation continues on its decelerating trajectory. The most watched data point today was the release of the Personal Consumption Expenditures PCE Price Index, the Fed's preferred inflation gauge. The core PCE came in at 2.5% year-on-year, in line with expectations but continuing its steady decline from last year's elevated levels. This print further cemented market expectations of a rate cut in the third quarter, with futures now pricing in a 68% probability of a 25 basis point cut in September. What's more telling is the month-on-month data, which showed just a 0.1% increase, indicating that price pressures in services are finally beginning to moderate. Wall Street has been waiting for a definitive signal that the Fed has room to maneuver, and today's inflation report, while not dramatic, offered just enough comfort to push the narrative forward. Over in Europe, the Stoxx 600 closed higher by 0.7%, recovering from yesterday's losses. The euro held relatively firm against the US dollar at 1.71 as ECB President Christine Lagarde reiterated that any future rate decisions would be highly data-dependent. Eurozone inflation data is set to be released early next week, and markets are cautiously watching core CPI readings from Germany, France, and Spain. There's increasing concern that persistent energy costs, particularly natural gas prices influenced by tensions in the Baltic region, may keep inflation slightly stickier in Europe than anticipated. Still, the ECB is expected to remain on pause until September, much like its American counterpart, though the political instability in France continues to cast a long shadow over investor confidence in the region. Asian markets saw a mixed performance today. The Nikkei 225 ended the session down 0.3% amid profit-taking in tech shares, while the Shanghai Composite is up 0.2% as Beijing announced a new stimulus package aimed at supporting consumer spending and real estate investment. Specifically, the People's Bank of China is preparing another targeted liquidity injection to ease pressures on small and mid-sized banks, and the government is expected to unveil new tax breaks for electric vehicle buyers and first-time homeowners next week. Investors are cautiously optimistic that China's slowdown may be close to bottoming out, although skepticism remains high given the structural issues tied to the property sector and weak household sentiment. In commodities, oil prices saw a modest gain. Brent crude closed at $84.12 per barrel, while WTI settled just above $80. Renewed geopolitical concerns in the Middle East, particularly around escalating tensions between Israel and Hezbollah in Lebanon, have added a risk premium to oil in recent days. Meanwhile, OPEC Plus is set to meet next week, and while no major changes in production quotas are expected, Saudi Arabia and Russia continue to emphasize the importance of stability in the oil market. Gold also held steady, closing the day at $23.42 per ounce. The yellow metal has seen strong demand over the past month, particularly from central banks and retail investors seeking protection from currency volatility and equity market drawdowns. Silver and copper also posted gains today, driven by improved industrial demand indicators out of Southeast Asia. In the currency markets, the dollar index held steady around 104.6 as traders digested the PCE inflation report. The Japanese yen weakened slightly to 159.4 against the dollar, raising speculation that the Bank of Japan may be forced to intervene again if the yen continues depreciating. Currency traders are closely watching BOJ Governor Kazuo Uda's upcoming speech, expected early next week, for clues about whether any additional policy action is on the horizon. The British pound gained modestly, trading at 1.267 as retail sales data came in stronger than expected. However, the Bank of England remains stuck in a difficult position balancing inflation that's still running hot against a weakening labour market. Now let's turn to the crypto markets, where volatility continues to be the name of the game. Bitcoin traded flat today at around $61,800, having rebounded from yesterday's dip below $60,000. Ether also stabilized, hovering near the $3,400 level. Traders attributed today's calm to a reduction in liquidations across major derivatives exchanges alongside relatively subdued funding rates. However, longer-term sentiment remains cautiously bullish as institutional interest continues to build. BlackRock's iShares Bitcoin Trust reported another day of net inflows, and new rumors suggest that Fidelity is preparing to launch an Ether-based product aimed at high-net-worth individuals. Meanwhile, Solana and Avalanche both gained over 5% amid renewed optimism about Layer-1 innovation and upcoming protocol upgrades. The meme coin segment remained quiet, although Dogecoin and Pepe Coin saw brief pops on social media chatter. Regulatory overhang continues to be a drag on altcoins in the US, but offshore exchanges are reporting increased volumes, suggesting a rotation of liquidity away from centralized American platforms. Zooming out, macroeconomic sentiment globally seems to be coalescing around the idea that central banks may finally be done tightening. From the Fed to the ECB, the Bank of Canada to the Reserve Bank of Australia, policymakers are increasingly using the language of patience, data dependency, and gradual disinflation. What remains uncertain, however, is whether economies can avoid a hard landing as monetary support begins to return. The soft landing narrative has been remarkably resilient, especially in the US, where labour markets remain relatively strong, wages are cooling without collapsing, and consumer spending while slowing is not crashing. But signs of strain are emerging. Credit card delinquencies are creeping higher, small business optimism is falling, and sectors like commercial real estate are flashing red. Corporate earnings have also become a central focus for investors. With Q2 earnings season about to kick off, analysts are watching closely to see if margin compression and slowing top-line growth start to weigh on profitability. Tech is still expected to outperform, especially names tied to AI, cybersecurity, and enterprise software, but traditional sectors like consumer staples, industrials, and financials are expected to post weaker results. Banks in particular are under scrutiny, especially regional lenders exposed to real estate risk and narrowing net interest margins. As we look forward to next week, several key events are likely to shape investor behavior. On Monday, we'll get Eurozone CPI data. Tuesday brings US consumer confidence numbers and the Chicago PMI. Wednesday will feature the ISM Manufacturing Index, job openings data, and the Fed's minutes from the June meeting. Thursday is the big one. Non-farm payrolls for June will be released, and that could be the deciding factor in whether the Fed chooses to signal a September rate cut with more conviction. Markets will be closed Friday for Independence Day in the US, making Thursday's data even more critical for short-term positioning. Geopolitically, the situation in Eastern Europe remains tense. Russia's latest airstrikes on Ukrainian infrastructure have been met with increased NATO surveillance flights, although no formal escalation has been announced. Meanwhile, talks between the US and China continue behind the scenes, with Treasury Secretary Janet Yellen expected to visit Beijing in July. Global investors remain hopeful that trade tensions won't escalate, but the Taiwan issue continues to loom large. Any misstep here could trigger significant market risk, particularly for semiconductor stocks. In terms of sentiment, the CNN Fear and Greed Index dipped slightly into greed territory today, indicating elevated optimism among retail traders. However, institutional positioning remains more cautious, with hedge funds increasing cash levels and reducing beta exposure. The VIX Volatility Index closed just below 13, indicating a relatively complacent environment, although options traders are beginning to price in more volatility for the second half of the year. Looking at sector performance today, tech was the clear winner, with semiconductors leading the charge. Healthcare stocks also performed well, bolstered by strong earnings guidance from several biotech firms. On the flip side, energy and utilities lagged as investors rotated into more growth-oriented names. Financials were flat on the day, though large banks like JP Morgan and Goldman Sachs managed to eke out modest gains. So, what does it all mean for you, the investor, the trader, or simply the curious observer? The key takeaway today is that we are entering a pivotal phase in the global macro cycle. The battle against inflation seems to be turning, but the risk now is that growth slows more than expected. Asset prices have already priced in a Goldilocks outcome: falling inflation, soft landing, stable earnings. But markets are rarely that tidy. Over the next few weeks, it will be critical to watch not just the headline economic data, but also the more subtle signals: corporate commentary, wage growth, credit conditions, and political developments. In a market like this, vigilance and adaptability are more important than ever. Whether you're managing a portfolio, allocating for the long term, or just staying informed, today's developments offer both opportunity and caution. Keep your eyes on the data, your ears on the central banks, and your portfolio aligned with your time horizon and risk tolerance. This has been your comprehensive daily market update for June 28, 2025. Stay tuned, stay smart, and as always, invest with insight.